Welcome to Iron Financial. Our mission here is simple. We cut right through all the market noise to help you forge stronger, more resilient portfolios. Today, we are putting Roku's explosive fourth-quarter earnings report under some pretty extreme pressure. Look, the market saw the headlines and, it reacted with total euphoria. But we're here to run the stress test. We are going to find out if this company is truly building a financial fortress or if what we're looking at is just a house of cards waiting for the slightest breeze. Okay, let's get into it.
So the second those numbers dropped, the stock just went ballistic. We're talking an 11.5% surge in after-hours trading. Now, that is the kind of explosive reaction that traders live for. It's a crystal clear signal that Wall Street was caught completely, totally off guard. This wasn't some minor beat, you see. This was a shockwave sent right through the market, and it tells you everything you need to know about the sheer strength of this report.
Okay, hold on a minute. Let's pump the brakes. An 11.5% pop is absolutely fantastic if you're a day trader, but we're not here for a quick sugar rush. No, we're here to analyze structural integrity, for the long haul. And that kind of immediate, almost euphoric reaction, it always forces me to ask, what is the market missing? Is this just some short-term hype that's going to fade as soon as the caffeine wears off? Or is there a truly durable, powerful structure being built here? That's the real question we've got to answer.
Exactly, and that right there is the blueprint for our analysis today. First, we're going to start with the earnings shockwave that caused this whole surge. Then, we'll move on and examine what I believe is the absolute steel foundation of this company, the platform business. After that, we are going to stress test the most obvious weak point, the devices segment, to figure out if it's a calculated flaw or a critical failure. And from there, we will forge ahead into their 2026 outlook before we deliver our final iron verdict.
All right, let's get right into the raw power of this report. Section 1, the earnings shockwave. We're going to break down the headline numbers that sent this stock into orbit and see just how far off the so-called experts on Wall Street really were. The sheer scale of the beat here is, well, it's staggering. Let's really break this down. Revenue came in at $1.39 billion. That's a solid 3% beat over the consensus. It shows really strong top-line growth. Okay, now look at adjusted EBITDA. That's a key measure of core operational profitability. It came in at nearly $170 million, absolutely crushing expectations by 16%. That shows some serious discipline and efficiency. But the seismic event, the one number that truly justifies that stock pop, is that adjusted earnings per share line. Wall Street was modeling 27 cents. Roku delivered 53 cents. That is a 96% beat. Folks, that's not a beat, that is an absolute demolition of expectations. It's a statement that the company's profitability engine is firing on all cylinders, and it's converting revenue into bottom-line profit for shareholders far, far more efficiently than anyone thought possible.
And that profitability engine, well, it's driven by one key segment, the platform. This is where we separate the core strength from all the superficial noise. You see, while the devices get you in the door, the platform is the load-bearing steel frame of the entire Roku enterprise. This segment is the absolute key to its long-term structural integrity, and it's what truly matters for any serious investor. And this chart illustrates the point perfectly. This isn't some one-quarter miracle. I want you to look at the relentless, methodical climb in platform revenue. It goes from $2.2 billion back in 2021 to over $4.1 billion in 2025. That, right there, is the heavy lifting. We're seeing an 18% year-over-year growth rate for the full year, capping off a multi-year trend of just powerful expansion. This chart shows a business with powerful, sustained momentum, a primary engine that just keeps getting stronger and bigger every single year.
Okay. $4.145 billion in full-year platform revenue is a massive number. I mean, you can't argue with that. But a big number on its own doesn't tell the whole story, does it? What's underneath this? Where is this strength actually coming from? Is it one single pillar holding this whole thing up, vulnerable to a single point of failure? Or is this a diversified, reinforced structure? I need to see the components.
And that's exactly the right question to be asking. And the answer is diversification. This is not a one-trick pony. The platform makes money from multiple, very powerful streams. You've got the core, high-margin video advertising. You have streaming services distribution, which means they get a cut when you sign up for other services through their OS. They have their own premium subscriptions. They're also monetizing content discovery with new features like the sports experience. And on top of all that, they're aggressively pushing for international expansion. So the crucial point here is that this isn't just one pillar. It's a multifaceted monetization machine, and it's designed to capture value from every simple interaction a user has with their television.
And let's just zero in on that biggest pillar for a second: advertising. This quote, pulled directly from their own shareholder letter, is absolutely critical.
They're not just growing because the whole market is growing. No, they are actively taking market share. They are growing faster than the overall streaming ad market and even the broader digital ad market. In a hyper-competitive environment like this, that is the ultimate sign of strength. It means advertisers are specifically choosing Roku's platform to spend their dollars because it delivers superior results. They are winning the ad wars.
And it's not just about winning over the big corporate advertisers either. This is where it gets really interesting for future growth. Just look at how simple they're making it with their Roku Ads Manager. They are essentially democratizing TV advertising. They're going after the massive $600 billion small and medium-sized business ad market. This isn't just about a big number, it's a strategic masterstroke. This is a market that has historically been completely shut out of TV advertising because of cost and complexity. By making it possible to launch a campaign in under 5 minutes, Roku is building a powerful new growth engine that diversifies its revenue away from being dependent on just a few dozen giant brands.
Now, let's talk about what really matters for forging a financial fortress: cash, free cash flow. For years, the knock on Roku was that it was a great growth story that just burned through cash. Well, take a look at this chart. This is a dramatic, powerful reversal. From burning $154 million in 2022 to generating a positive $484 million in 2025 on a trailing 12-month basis. That's a 138% year-over-year increase. It's like the company has flipped a switch. They've gone from consuming capital to generating it at a massive scale. This is proof positive that the platform's profitability is now strong enough to fund the entire enterprise, and then some. This is what financial discipline looks like in action.
All right, enough with the victory lap. The platform looks strong, I'll give you that. You can't ignore that cash flow. But you can't build a skyscraper on a foundation that has a giant visible crack in it. It's time to look at the other side of the ledger. Let's talk about the hardware. Let's talk about the part of the business that is actively, consistently, and yes, intentionally losing money. Is this a strategic flaw, or is it just a fatal one?
Here it is, right in black and white. This is the core conflict at the very heart of Roku's business model. On one side, you have the platform. It's a beautiful, high-margin business throwing off cash with a gross margin of nearly 53%. On the other side, you have devices, with a gross margin of negative 23.3%. Let's be perfectly clear about what this means. For every single dollar of hardware Roku sells, every streaming stick, every TV, they are losing more than 23 cents. They are literally paying customers to take their products. This isn't just some low-margin business. This is a money pit.
Which brings us to the single most important question for any long-term investor. Is this a brilliant strategic loss leader, a calculated cost to acquire a customer that they can then monetize for years and years, or is this a permanent structural crack in the very foundation of the company? Because if you have to lose money forever just to get customers in the door, at some point, that math just doesn't work. How long can you subsidize growth before the whole thing just crumbles?
It's absolutely a calculated cost. See, the device is not the product. The user is the product. This is the classic loss leader strategy, and it's being executed at a massive scale. Every 23 cents they lose on a device is a customer acquisition cost. It's an investment to acquire a user for their 53% margin platform. They are buying access to a customer's living room. Each device sold is just another entry point into their high-profit ecosystem of advertising and subscriptions. So the crucial point is that those device losses aren't a crack in the foundation. They are the foundation. It's the price of admission to build that profitable skyscraper on top.
So you're arguing the strategy is sound. Well, the ultimate test of any strategy lies in the company's own projections. Does management actually believe this model will continue to generate accelerating profits? Or are they signaling trouble ahead? Let's move on and see how this all builds into their forecast for 2026. This is where management puts their credibility right on the line.
And their credibility looks rock solid. The guidance is exceptionally strong right across the board. For the first quarter of 2026, they're guiding to $1.2 billion in total revenue, which is already above what Wall Street was expecting. They're projecting platform revenue to grow more than 21% year over year. And look at that adjusted EBITDA for Q1, $130 million. For the full year, the numbers are just as powerful. $5.5 billion in revenue, 18% platform growth, and a massive $635 million in adjusted EBITDA. This is not the guidance of a management team that's worried about a crack in their foundation. This is pure, unadulterated confidence.
And let's put that full-year revenue number into perspective, $5.5 billion. The analyst consensus, right, the best guess from all the experts on Wall Street, was $5.34 billion. So Roku's management came out and guided nearly $200 million higher than that. They are signaling that their internal models show even more strength and momentum than the most optimistic analyst on the street was willing to predict. That's a bold, powerful statement. And it's the exact same story with profitability. Wall Street's consensus for full year 2026 adjusted EBITDA was $581 million. Management guided to $635 million. That's a significant beat of over $50 million. So they are explicitly telling the market that not only will revenue be stronger than you think, but our ability to turn that revenue into actual profit will be even stronger. This directly addresses the core concern. The strategy isn't just driving growth, it's driving highly profitable growth.
And this right here is the end goal. This is why they are willing to lose money on devices. It all comes down to one thing: scale. Their stated goal is to hit a milestone of 100 million streaming households globally in 2026. Every single device sold at a loss is another step toward this massive, powerful user base. Once they hit that scale, the network effect and the value of their advertising platform become immensely powerful and incredibly difficult for competitors to challenge. The device losses are the fuel for this global land grab.
Which brings us to the end. It is time to weigh all of the evidence. The explosive earnings, the steel-strong platform, the calculated flaw in the hardware, and that confident outlook. It's time to deliver the iron verdict. Is Roku a well-forged opportunity for a strong portfolio, or is it a trap for unwary investors?
The bull case is clear, and it's compelling. What you are looking at is a financial fortress. The core structure is a dominant, high-growth platform business with massive 52.8% gross margins. It's now generating an incredible amount of free cash flow, which proves its self-sufficiency. It's not just growing, it is actively taking share in the advertising market. And management's own guidance shows supreme confidence that the strength will not only continue, but actually accelerate into 2026. This is the blueprint for a market leader.
But every fortress has a potential point of failure. The bear case centers on that necessary gateway, the hardware. They have to keep losing money on devices just to feed the profitable platform. That is a structural dependency that absolutely carries risk. And let's not forget who they're fighting. The competition isn't a bunch of small startups. It's Amazon, Google, and Apple. These are trillion-dollar behemoths who can afford to lose money on hardware for a very, very long time. Roku's entire model relies on winning the ad war, and that is a brutal, expensive war to fight against those giants.
So, the final analysis is this. Roku has definitively proven that its business model can build a powerful, profitable financial fortress. They are executing with what looks like ironclad discipline. The structure is sound and the engine is strong. The only question that remains, the one that will determine its fate over the next decade, is how deep and how wide is the moat they can build around that fortress to defend against the biggest technology titans in the world. And that's what you need to decide.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.